Welcome back, traders, to Benzinga's pre-market prep, brought to you by MarketFi. Joel Elconin back with Dennis Dick and Ezra Rapoport on the line. Ezra, how you doing?
I'm great this morning. How are you? Merry Christmas.
Yeah, Merry Christmas. Dennis, how you doing?
I'm doing good. I guess we need somebody like Ezra here who knows the computers because we're having technical difficulties all over the place here, Ezra. You ever get technical difficulties as a high frequency trader?
Welcome to my life.
Welcome to your life. So we got a little glimpse of it here this morning. Our producer is remote here, and then we're running kind of a skeleton crew because of the holiday season here. So this is your life technical difficulties. Tell us more.
Yeah, you got to.
Absolutely no. For me, the edge is about navigating the technical difficulties that other people are intimidated or unwilling to navigate. Right? I think a fair amount of what I do is about getting onto a technological tier that's that's advantageous for me. That means being flexible, cutting edge. I try to keep a mentality on my desk that we'll be. We always tell our vendors that we're happy to be the first when they're rolling out a new product, a new API. We want to be there, and we inevitably understand that when you're pushing the envelope, you are going to be dealing with difficulties, setbacks, by nature, being in an innovative place technologically, which you guys are too. You're going to encounter those kinds of problems, and it's just about rolling with it, which you obviously did.
Do you got a good story for us? Dennis was telling us when he was running his Russell rebalance, he didn't turn off his algo, and as he was selling stock, he was buying it right back at a different account. Do you have any similar story like that you'd like to share with our listeners?
Well, I do definitely live for the random 2 or 3 days a year when some other shop flips on their, some new gateway, some new algo, and it starts causing the spread in both directions. And, I try to be there on both sides of that. That definitely
provide
happens.
Liquidity to their bad algo.
All day. That is a dream.
All day.
It happened a couple weeks ago, actually. I printed out the logs. I was, at the end of the day, I realized I just saw a volume spike in one of our instruments, and I went and looked at it, and I saw that the rate at which people were lifting our offers and hitting our bids was just, outrageous, and way too consistent to be any real market activity. It was obviously something blowing out, and the duration for which it lasted was, just long enough for the exchange to recognize the unusual activity and shut down the malfunctioning counterparty. But so we got, about a minute straight crossing on both directions. And what I did is I printed it out the logs, highlighted the buys and sells stills in opposite colors of the highlighter, and I left it for one of my partners because we're working on getting faster gateways on that exchange. And I told him it was a cash grab scenario, and you get me the faster gateways, and we can put a multiplier in front of that.
Was that I want to ask you what the individual instrument was. Was it a future or was it an individual stock?
It was in the futures market, definitely in the futures market.
Wow, and you're just sitting there on the bed, and they're hitting you on the bed and simultaneously getting lifted on the offer.
Yeah, basically.
That's what market making is all about right there.
That's why you've got to be there every day grinding it out, because once in a while you get those days where there's just something like that. But yeah, again, that's just the nature of, technology and, penetrating into markets, and basically, I couldn't possibly share, without, going into shell shock, any negative technological experiences, but, there's all kinds of stuff.
What about the night debacle day? Because that's basically what that program was doing too, was basically buying and selling, or actually, and it was kind of one directional for a while too on certain instruments where they were just buying in little waves on certain stocks. And they were selling in stocks and waves on other stocks, and they were knocking certain stocks down percentages. And that algorithm went on not just for a minute or two, it went on for almost a half an hour. Were you trading that day, Ezra? And did you analyze any of the trading action from that day?
Yeah, I was trading. From what I understand, and yeah, it's a great example. And from what I understand, what led to that is basically what I'm neurotic about, which is, release process, the process from going from, your test and certification scenarios to your live market trading scenarios. Basically, I think what happened is they rolled a new change into production, and basically your process for releasing new code changes into production has to be incredibly rigorous because you basically you've got a body of working code that's a tank, that's been making markets across hundreds of instruments. You introduce a small change and you don't know if that's going to like let an axle loose or something. You really have to test the heck out of it. And basically what happens is somehow the production environment for Knight, got corrupted, and they somehow mixed what they thought was their development environment with their production environment. So they were doing all their test scenarios. They were actually running in the live market, from what I understand. It's anecdotal. I wasn't working there, but I have it on very reliable, and from what I've observed. And basically, as I understand it, exchanges were calling them, and one hand had no idea what the other was doing, and basically. The market, when you're trading that much volume, it's very difficult to know intraday what your P&L is, what your positions are, even when you have that many counterparties, that many transactions going on. And so they operate, in the dark a lot, in the intraday. And that's kind of a scary thing also about doing large volumes is that happens. And so they had, I think, exchanges calling them, telling them, it seemed like unusual activity, they're taking on large amounts of risk. But to a certain extent, that's also the hallmarks of scenarios where you're going to be, making a lot of profit as a market maker. Sometimes it's very unclear in the heat of battle whether, the fact that you're taking on risk is a healthy thing or very, very, time that something's very wrong. And I think that, humans were involved and, the exchanges called them and asked them if they wanted to shut it down. And I think that repeatedly, people, humans told them, no, keep it up. Keep it going. And it was, I think it took, and like you said, it wasn't a minute. This went on for a while. I think it took a while to figure out basically that someone, on the development side had completely botched the release process.
Wow.
Yeah, it's incredibly, very scary. And these are the kinds of things that can, ruin,
Yeah, I
large.
believe they lost, I think they said over $400 million that day, just in that 27 or 28 minutes that this rogue algorithm took over. So an incredible amount of money lost instantaneously there. So you definitely do have to be careful, obviously, when you're, doing this. Talk about your process there then, Ezra. Like, what is your process to ensure that this stuff doesn't happen to you?
Well, basically, you can't be neurotic or paranoid enough. And I think, it's increasingly relevant as I think a lot of, even day traders are becoming increasingly, pattern-based, systematic. And, I think a lot of people are also starting to tend toward automation, even in small capacities. And you need to really just, you need to be rigorous and, ruthless about testing the heck out of any small changes. Any small amount of automation that you're going to be releasing into the market has to be tested through a wide range of scenarios, from the mundane to the most unlikely. You have to test, what your how your automation is going to behave in a flash crash, and you have to test how it's going to behave, after it's done, on its million first, fill or whatever. You have to run it well beyond the bounds, and you have to be paranoid. You can't ever let it run without procedures in place, kill switches. And on my desk we have processes in place for what happens if a G20 nation invades another one. What happens if what happens if on a G20 sovereign risk upgrade or downgrade. You really have to, when you're dealing with automation, you basically have to have scenarios, procedures in place for every scenario.
So when the unexpected happens, you just hit the kill switch and it's done? Like, is there a human being always monitoring your algorithmic action? Like, do you have somebody sitting there? If you're running algorithm, do you take off and go to the bathroom, or do you just are always sitting there watching that algorithm run? Is there always somebody sitting there watching it run?
Well, yeah, two questions.
Okay.
Yes, someone always has to be observing the automation. More interestingly, the trick actually is, you don't want to necessarily shut your algo down at every sign of something unusual, right?
If
you have a thoroughly tested, the thing is, a lot of the time you're waiting for that unusual scenario to occur. That is, when you get those, those profits. Those are the days. That's the reason you grind it out, especially, in futures markets. You're grinding it out 23 hours a day. It's because there are bursts of profitability. Yes, ideally you want a trickle of profitability at all times, but you definitely need to be there when there are those offsetting profitable occurrences. So the trick is, really to have everything so tested, that when the unexpected happens, you can rely on your automation to handle it. As long as you've got procedures in place and, you've been, thoroughly and, you've got enough experience on the desk that, put the automation in place, then when the unexpected happens, you got to kind of bite your tongue, sit on your hands, and let your heart go into your throat and trust your process.
Joel, I think Joel was trying to
We're
say
we're on the line with Ezra Rapoport. He's head of automated exchange at Flammarion Capital, joining us here on Benzinga's pre-market prep. Ezra, I just finished Flash Boys when I was on vacation, and Dennis and I have talked about the book at length. Really, it started out with a bang when they were, talking about building the tunnel, and they went on quite a bit, ad nauseum about, the different firms and stuff. And I think the thing that sticks out in my mind is the ability of these firms, some of these firms, never to have a losing day. And to me, that kind of characterizes something that is really not trading. I mean, to me, you got to have losing days in order to, to get experience, to learn from your losses. I think anybody can attest to that. And you don't have to tell us, your exact record or your exact, consecutive days of wins or losses streak. But, is that just incredible that these firms can go on and never have a losing day?
Let's talk about that. I'm so glad you asked that question. Basically, here's why it's still trading in the cases of some of these shops that, don't ever have a losing day. And basically, high sharp trading is a different kind of trading. Kind of trading that, that my desk targets, that, the virtues, basically what you're doing is, you've got basically a good day trader sitting at home, has figured something out. He's got a coin he can flip, right? He's maybe got like some 60-40 coin that's like 60-40 in his favor. Every time his signal comes along, right, he gets to flip that coin, and, 6 times out of 10, it's going to come up his way. And so, if he's disciplined about it, he's got a system, a disciplined home trader can make that 60% coin work for him. He can probably make a profit out of that. Right, and we can all understand that, and we all understand that more likely almost about half of his days are going to be losing days. He just has to be good at risk management, and he can extract some profit from that. Right, that's how we see trading, I think. Now, what places like Virtue, or some of these high frequency shops, what I try to do is take that 60-40 coin, and what if you can get a whole bunch of those coins? What if you can go out and find 100 of those coins? And you can basically diversify your participation so that instead of just flipping one coin every day, you're flipping 100 coins every day. Mm-hmm. Well, all of a sudden, okay, if you diversify to 100 or even 1,000, okay, and your risk management is effective, okay, then even though you can be taking losses on any given day, in any of those instruments, okay, with effective diversification, when you've got a ton of those coins and you're flipping them, okay, there's basically, a binomial probability. It basically allows you to, with each diversification, reduce your risk of taking an individual losing day. And when you get into 1,000 products, 5,000 products, my desk is not on that scale. And so we do incur losing days. Losing months, significantly more rare, losing years, but when you scale into greater numbers of products and you have more and more of those coins that you can flip, you can scale down the time scales along which you'll be unprofitable. So places, those high-frequency desks with extreme numbers of products, do they have unprofitable minutes? Definitely. Do they have unprofitable hours? Probably. Do they have unprofitable half days? Very unlikely. And do they have unprofitable days? No. And that's how it works. By increasing your diversification, you can decrease the timescales along which you're likely to be unprofitable. Are we still flipping coins? Yes, we're still flipping coins, and so it is probabilistically possible that any day could be a losing day. The idea is to diversify that to a minimum, and and that's what high frequency does. That's to a bit of an extreme, which is intimidating.
Yeah, great point. And I would just add to that, if you added to the fact that you're trading against retail and blind retail and it's coming into your dark pool, I mean, you basically have the option of, oh, yeah, I can make money on that order. I'll take it no matter what it is. No, that order looks a little tricky. I don't know if I can squeeze out a couple cents on that. I'll send that one to the exchange. So that also increases your profitability, or your chances of profitability as well.
And I want to add on that. That's not all high-frequency traders, though, too. That is just,
Right.
Your privileged internalizing high-frequency traders. So not all of them. A lot of them are just exchange traders, right, Ezra? So you guys aren't doing any of this off-exchange stuff, are you? You're mostly on exchange.
That's a great point.
Yeah.
That's a great point. I've been at shops where I've had access to that. Currently, my desk is, we are completely just, buy-side customers of the exchanges. We don't have any privileged flow access or anything like that in our markets. But it does relate to the same basic scenario. I see the connection, which is, basically when you start diversifying like crazy, you don't get those 60-40 coins. A good day trader, some good day traders have these 90% coins that they're flipping. They're doing great. When you get to the point where you want to diversify like crazy, you get to the point where you'll take a 51% coin. You'll take a 50.00001% coin. And when you get to that point and your margins are squeezed that tight, then you're going to go to all kinds of extremes like, finding the cost benefit, is in your favor to participate in a dark pool where you can select for flow that you may or may not accept. These kinds of things, when your margin gets squeezed, you will look for every tiny little advantage that you can seek to continue to diversify and allow you to take more and more of these coin flips, even if they're only a tiny bit of the probability is in your favor.
Okay, thanks a lot, Ezra. Great chat today. Sorry about the technical difficulties. We'll have you back on again soon.
Looking forward to it.
Okay.
Thanks, Ezra.